and welcome. You're watching Business Television India and this is the Financial Planner. I'm Fatima Mahdi and of course I have with me the Deputy CEO Anand Rathi, Feroze Azeez. Feroze, wonderful to have you on air with us right here on Business Television India. Today I want us to talk a little bit about equity fund alpha updates. Let me start by asking you to take us through what sort of alpha delivery we've actually seen when it comes to mutual funds and what exactly has sort of been happening over the last 10 to 12 years.
I think Fatima, for this, I think it's a very important topic, alpha. But I think for the sake of viewers better understanding, because we in the world of finance use nomenclature, which sometimes becomes more intimidating than it actually deserves to be. Alpha is nothing but the extra return the fund manager creates over and above its benchmark. Benchmark is nothing but what the fund manager is comparing himself or herself against. So for example, in a large cap fund, if Nifty is the benchmark, the extra return which the fund manager creates over and above Nifty for a specific period of time is called the alpha. If Nifty delivered 10% return in the last 1 year, but the fund delivered 13%, so the alpha is nothing but the arithmetic difference of 13 minus 10, which is 3. So 3 is the extra return. So alpha is a very, very important variable, Fatima, like you said, because everybody is paying a fee to a fund manager just to get a grip and get some share of this extra return over and above the benchmark which the fund manager uses all his might, intellect and research to produce.
Okay, so thanks for specifying that, Feroze. But what I want to actually ask you a little bit more is, we've seen certain activity over the last, I guess, 12 years. In fact, you've sort of tabled that, okay? 2018, however, seems to have been a bit of a different year. Does it imply that funds have lost the ability to deliver alpha, or are we actually looking at a situation where we're going to be seeing alpha coming back?
Yes, I think it's very important to comprehensively put the data to get a sense so that you can see 2018 in context rather than out of context. So 2018 has been a very bad year because only 5 out of the 203 schemes which we analyzed, only 5 of them have beaten their benchmark, which is 98% of the fund managers whom you paid fee to did worse off than the benchmark, which is not a pretty situation to be in or a happy situation to be in. I pay a fee to underperform the benchmark. So this is an aberration. So most people might end up concluding incorrectly that fund managers don't generate extra return and see 2018 out of context. So that's why this table, Fatima, becomes very important so that you can take the previous 11 years also into consideration before you derive any conclusions out of an aberrative year of 2018. So 2007, we had out of the 107 schemes, 70 of them outperformed the benchmark, which is 65% of the total number of schemes available outperformed. Similarly, in 2008, 47 out of 126, which is 1/3 approximately, were the schemes which have beaten the benchmark. So 2008 was worse off and 2008 was a very different year. That's why you see mutual funds have not done too well and they've done worse off than the index. 2009, 72% of the total number of schemes outperformed the benchmark. So on and so forth. If you see the average number of schemes which outperform the respective benchmark is 63% of the schemes outperform. So that's 2/3 of the schemes approximately beat the index and 1/3 of them underperform the index. When all of them pursue to outperform the index, only 2/3 end up doing that job. And 2018, only 2% of them have beaten the index. So point one is this table gives us a synopsis of how alpha has been generated and how many of the total aspiring fund managers or fund managers who are aspiring to create an alpha ended up actually meeting their objective.
Okay, just to flesh that out a little bit more, and you've sort of talked about it. I just want to understand one part that we're talking about. That it says it's noticed that whenever mid caps underperform or at par with the Nifty large cap, the number of funds generating alpha falls below average, as can be seen in years such as 2008, 2010, 2011, 2013, and 2018. Explain this a little bit more to me, Feroze, and how should investors really interpret that?
See, if you look at mid caps, firstly, before we get into that, what are mutual funds? Mutual funds are a well diversified platform. If a broader market, if a diversified platform is subject to a concentrated rally in the market, if the market has moved on very few stocks, then mutual funds tend to underperform because they're diversified. Whenever the rally is concentrated, a diversified platform is bound to underperform, and vice versa. So if you see, if you look at 2007 to 2018, Nifty in the year 2007 did 54.8, and Nifty mid cap, which is the mid cap representative, did 76.9. So that means the mid caps outperformed the benchmark, the Nifty, by 22.2%. So this is a year where mutual funds would have done significantly better, and that's what we see in the previous table. That means 70 of the 107 outperformed the benchmark. So if you see this table where every year mid cap has outperformed the benchmark of Nifty, there has been a better performance on the mutual fund front as well. And 2018 was a year where mid caps underperformed Nifty, and in turn the mutual funds did worse off than the Nifty.
Okay, fair enough, and thanks for really explaining that to us so clearly. So if you were to sort of summarize the tendency that we've seen with mid-cap delivery, what would you like to say? And also, I want you to just clarify a little bit more, because we've seen a SEBI mandate to recategorize funds, leading the equity fund industry to restructure and reconstruct portfolios. That, of course, in turn led to some churn and volatility. Just give us a little bit more on that, and also the fact that it appears to have been a one-time activity, and now you have funds that have been streamlined since in terms of meeting regulatory requirements. Tell me a little bit more from your vantage point, how that has worked, and how you would sort of perhaps like to take us through a little bit more on that.
Yes, so if you look at one reason, of course, now when we are analyzing the bad performance of 2018, to my mind there are four reasons. If you go, one of them which we just mentioned was Nifty mid cap doing worse off than Nifty. So whenever that happens, you see underperformance of the mutual fund. That's one reason which we just discussed. The second reason is SEBI last year came up with the definition and categorizations of mutual fund in the year 2017, applicable from 1st April 2018. So this circular required a lot of fund managers to change their portfolios, recategorize their schemes, rename the schemes. There was a definition to what is a large cap, what is a mid cap, what is a small cap. This change resulted in a huge churn relative to what the rest of the years would have seen. For example, the SEBI circular said the top 100 companies as per market cap become the large cap companies. The subsequent 150 companies from 101 to 250 are going to be called the mid cap companies, and anything beyond 250th company in the country listed equity will be called as small cap. This was a revolutionary definition to market capitalization. Earlier, fund managers would even call a 8,000 crore company, market cap company, as a large cap, whereas by this definition almost 8,000 crore companies and below become a small cap company. So this required a lot of change, a lot of modification in people's portfolios, fund managers' portfolios, and that resulted in mid caps actually being shed from portfolios, flight of capital from mid cap to large cap. And this was a one-time activity, like you, Fatima, specified, because you don't get these kind of regulatory changes on a yearly basis. Those are discrete in nature, happen in 10-15 years once when the industry has changed shape. So that was the second reason why there was huge underperformance last year, and only 2% of the schemes ended up outperforming the index.
Okay, Feroze, given what we've discussed so far, and of course the opinion that the House has, which is that the ability of Indian funds to get back into alpha generation is strong. Uh, Tell us a little bit more about the main reasons you think. So let's start with the fact that, you've talked about the aberration that we've seen earlier, and of course the impending correction. But if you could just flesh out why alpha generation, the possibility is very, very strong, and really sort of list the reasons why that belief exists. That's sort of what one is looking for here.
See, Fatima, like I was just mentioning, there are four reasons out of which we discussed two of them. The third reason, let me go to the third reason, which we were discussing, and let's see why 2018 has had underperformance. That's because the rally was concentrated. Even in the Nifty, if you see the top 5 companies in the Nifty which contribute to 37% of Nifty, which are really, really mega large cap companies, they have contributed to Nifty's movement substantially. So inside the Nifty 50 companies as well, the rally has not been well spread. The rally has been, bottom 45 stocks have not done so well. The top 5 stocks have done phenomenally well, so much so that the other 45 put together have lost money. The top 45 have gained humongous amount of money. So concentrated rally is the third reason why 2018 calendar year and FY19 financial year turned out to be so bad for equity mutual funds. So as the table depicts, the weights of the top 5 companies and the return contribution in Nifty, whenever you see the top 5 companies giving a large portion of Nifty rally, you see that mutual funds underperform, and the last 12-year data clearly shows whenever the rally in the top 5 stocks of Nifty has been huge, then the mutual funds actually underperform because everybody might not be holding the same 5 stocks in the right quantums. So that's a very important reason. So I think these are few of the reasons why 2018 turned out to be the way it was. Now coming to your question, Fatima, of why do we strongly believe that the future could be different? Because I think all these points don't sustain for long periods of time, and I think they've come to a fag end of their impact on the mutual fund industry, and that's the reason why we think that alpha generation in India is here to last another 5, 7, 8 years. And it will give people better returns than an index fund going forward.
Okay, so just a little bit more. I understand the recommendation is to continue allocating to actively manage mutual funds. The strategic allocation that's recommended is with a 65% large and 35% mid and small cap exposure. Tell us a little bit more about this, Feroze, as well as, of course, the kind of ratio that is ultimately beneficial for investors.
Whenever you invest in mid and small cap, in mutual funds, the most important question which comes up is how much to large cap, how much to mid cap and small cap. These two categories require some degree of deliberation. So let me give you a thumb rule of how to allocate money between large caps and mid caps. Whenever mid caps are extensively priced relative to large caps, that time you should give lesser money to mid caps and more money to large caps. For example, in 2018 March end, what had happened was Nifty was at a 24-25 PE, Nifty mid cap was at 50 PE. That meant that Nifty mid cap had really stretched itself in valuation terms. So at that point in time, a year back, you should have reduced your mid cap exposure. If you didn't do it, then of course your portfolio underperformed substantially. Now this year, as we stand today, Nifty P is from on a trailing basis December to December shows on the NSE website of almost 26, 27. Nifty mid cap is only at 31 PE. So the difference between Nifty mid cap and Nifty is just a 4 PE. So last year it was 26 PE difference. Now there's 4 PE difference. So now is the time where you can actually increase your exposure to mid cap. Thumb rule, matlab contemporary allocation could be 60-40 or 65 towards large cap and 35 towards mid cap, and alphas will return in the next couple of years, and very well so. And I think concluding that alphas are gone is a very wrong conclusion in my opinion, and value will be created by active management rather than passive management.
Okay, Feroze, I'm going to ask you to hold on to that thought because we have plenty to discuss. We're coming right back with a short break right here on Financial Planner. You've done a wonderful job of explaining the significance of alpha in terms of how it has worked in terms of trend and cycles as well. We have, of course, talked about how generating alpha, of course, was a bit of a challenge, especially in the recent past. There was a line of thought that was gaining currency at one stage, especially amongst HNIs. The attractiveness of passive funds, so to speak, versus differently managed funds. Tell us a little bit more about the kind of observations you've had when it comes to HNI investments, as well as how fund managers have sort of been working around that as well. Because we've sort of talked about what happens when alpha is not generated. Then what? What is the plan? We've also talked about the trajectory going forward. But what are some of the very important things that investors should keep in mind when it comes to this overall scenario?
See, passive managed funds are nothing but those funds where you have an index which the fund manager needs to replicate. So you can have a nifty benchmarked index fund which is called a passive fund. As the nomenclature suggests, there is no active management. The fund manager does not use her or his judgment to allocate money between different stocks. It just passively tries to imitate the index. So the benefits of this category is that it comes with a lower cost, almost saves you 50-60% of the cost, or brings down the cost to half of what it is in the active management or even lower. That's one and only benefit of a passively managed fund. But an actively managed fund has the potential of outperforming that index. So this debate, every time there is an underperformance of mutual funds, active managed mutual fund, this debate surfaces itself and this passive vis-a-vis active debate happens. So passive funds are very cost efficient. In times like 2018 and FY 2019, you will definitely see passive funds gaining traction, and HNIs would try and definitely make them a part of the portfolio. But I think as I already spoke, active management is the best way to go in India. If we were sitting in the US, a large portion of the money is managed using passive, not active, because it's an emerged market. Information arbitrage is low, efficiency is very high. So we have a long way to go before we become a market as efficient as US. At that point in time, I would also advocate a passively managed fund. But currently, as we sit and where we are in the situation, I think active is the way to go.
Okay, Feroze, just going back a little bit in terms of strategies that are being, adopted to generate alpha in the kind of markets that we've witnessed. Which space have you guys been sort of cautious in when it comes to sort of actively looking out for that? Tell me a little bit more about, the context, also given the kind of pre-election rally that we saw earlier, as well as the kind of volatility that we've continued to witness. Tell me a bit more about in terms of, what's really buzzing when it comes to investors at the moment. How are you guys thinking?
So we are thinking that, of course, news flow, as important as the general election, is definitely going to impact the market, and it's going to impact different stocks very differently. So these are times where there's going to be, it's like sailing through a high tide kind of a situation. So making sure that you have your strategic allocations well thought out. You should keep your risks under check. People actually have more equity than they desire to in certain situations like these. So make sure, point one, we're telling our investors to keep your strategic asset allocation correct, and make sure that your portfolio is mirroring your thought process. Second thing which we are saying is use products which have an inherent hedge in it. Like for example, the structured products we do protect people for 20-30% of downsides in the market. These are very good products to plant in your portfolio to a large quantum of almost 25 to 40% to make sure that you sail through this speed breaker far more efficiently. So these are the two very important things which people have to keep in mind. And third is to make sure that don't just be worried about the news, because I think there are other positives on the other side. And people take a lot of panic decisions, especially when it comes to equity markets, which have behaved very sporadically over the last 6 months. If you dive deep into the markets and leave the headline numbers like Nifty and Sensex, you see a lot of pain which has happened, and I think that should reverse itself, having seen such a large correction in the mid-cap space. So patience, inherent hedges, and making sure that you are sticking to your strategic allocation and not deviating from it are the three pieces of advice which we've been giving in times of anxiety, which is what general election brings to table.
Anxiety indeed. And very quickly, Feroze, what sectors do you see real value in when it comes to the mid-cap and small-cap space?
See, I think when you look at sectors, of course, we personally believe from a value standpoint, pharma is a sector which has value. From a growth standpoint, definitely infrastructure. If there is status quo in the governance at the center, infrastructure stocks will certainly do very well over the next few years. And anything which is infrastructure is a very broad theme. So all stocks under infrastructure should do well if the government continues, the same government continues, and the thrust on expenditure on infrastructure, which will gain momentum again, like it did in the year of 15, 16 and 17. I think these are the two things on the defensive and the aggressive side you can pick as a sector preference.
Okay, and Feroze, because we actually for once have a little bit more time than we usually do, just your quick take in terms of the fact that we've seen debt mutual funds having done better recently than equity funds in the last 1 year. What is your easy explanation to investors?
See, that's not a surprise to me, because equities are not a constant return, they are a variable return. In fact, the probability that the debt fund in a given year will beat equity will be more than 50%. Because if you look at the last 15 years, half the time this statement which you just mentioned, Fatima, would be valid. And equity follows a very different kind of a distribution, by which I mean equities generally give very suboptimal returns year on year, and then comes a very good year which pulls the average return up. This phenomena is called a chi-square phenomena. It sounds more complex. So point what I'm making, Fatima, is debt funds have outperformed equity funds over the last 1 year. That's not a surprise, because that happens every 2 or 3 years. Because equities don't move up linearly, they move up in a wave fashion, and that's why debt funds will outperform. Second, equity markets follow a very different attribute of giving suboptimal return most of the years, and there comes a one good year which makes up for all the lost time. For example, last 30 years, the average return of the headline index is 15%. But if you remove 3 best years, out of these 30 years, the return average drops from 15 to 5. So that's how skewed equity returns can get over shorter spans of time.
All right, Feroze, always a pleasure speaking to you. Thank you for that extensive conversation we've really had in terms of understanding what is happening when it comes to equity fund alpha significance, as well as the cyclical patterns that you are anticipating. Interesting to see actually the kind of reasons you think that there's a very strong case for alpha to be very much, alpha generation to remain strong going forward. Thank you as always. That of course is Feroze Azeez speaking to us right here on Financial Planner, right here on Business Television India. Programming always continues right here. Thank you for watching.